What I look to do in the next 20 minutes or so is just give an update on NBPE, what we look to achieve with the strategy, how we differentiate actually from a number of the trusts you've heard today. We'll talk a little bit about our Neuberger's private markets platform for those of you who aren't aware of NB, and then focus and drill down into kind of our co-investment portfolio, which is what we focus on. Just in terms of the next couple of slides, as you can see, NBPE aims to invest in private companies to generate long-term growth. We do this by getting direct exposure to private companies, investing globally, but with a focus on the United States, and invest alongside top-tier private equity managers in their core area of expertise. The strategy originally launched in 2007 as a fund of funds, but today we transitioned shortly after to focus purely on equity co-investment. I know that Andrew mentioned for Columbia Threadneedle, they do a bit of a co-investment as well. And we'll talk a little bit more around co-investments and the benefit of the co-investment model, because I think we're differentiated in our approach in the fact that we're the only London-listed fund which purely focuses on co-investment today. And co-investment, as many of you know, is investing directly into specific private companies alongside private equity managers. So the strategy, NBPE, is 1.2 billion in size in terms of net assets. We pay a semi-annual dividend of 3% on NAV of greater. So last year we paid out about $44 million in 2024, and this year we've already announced our H1 dividend due to be paid at the end of February, about $22 million. Much like a number of our peers, strong performance track record over the long term. 5-year total return of NAV, total return of 65%, and a 10-year share price return for our investors of 219%, so in line with OCI. And the final number on this page, which I'll look to talk about a little bit later, is 34.6% average uplift on IPOs and realizations for the last 5 years. So the strategy today is 82 holdings across 52 different private equity managers. So I know a lot has been talked around. I won't spend a great deal of time on why private equity and the case for private equity, but I just thought it'd be interesting just to position NBPE compared to some of our listed peers, some of you we've heard from this morning. So there are different approaches to obtaining direct access to private portfolio companies, as many of you know. So you've got primaries, so very much like Harbour Vests and what CT do, and the fact that they invest in primary funds as they give money to private equity managers who will then go out and buy a portfolio of privately owned businesses. You've got secondary transactions or strategies which will buy these stakes off original investors. So you can see on the bottom of in the middle box. And you've got co-investment, so buying direct minority investment directly into portfolio companies alongside the private equity manager. And this is what we do at NBPE, so we focus on. And as you can see, we at Neuberger Berman, we're buying direct positions, like in this case, Into Action, which is owned by 3i. And then just to give you a bit of colour and context in terms of how we position. So in the listed private equity space, you've got the fund of funds, so the Harbour Vests of this world, as Richard excellently spoke about them earlier this morning. You've got the direct managers like OCI, as Stephen was talking about. So the direct private equity managers who are making the investments and doing the investments themselves. And then we've got NBPE, which is a bit of a hybrid in the fact that you're getting the diversification of a multiple manager exposure, but then it's direct, you're getting direct exposure as well, i.e. we're choosing to invest in specific businesses alongside private equity managers. And I think that's interesting to see. So we sit in the middle of that. And some of the benefits of the co-investment model, which I think it's just really important to highlight, and the fee efficiency is a key point. So we're paying no management fee or carry on the investments we make into these underlying businesses. We're providing equity to the private equity managers to either continue the value creation strategy or story, or to continue to grow and build this business, or to return some capital to original investors of the company. It's very capital efficient as well. So from us, as it says, we're tactically able to allocate and invest opportunistically. We ultimately control the investment decision. So we're able to build portfolios, investment by investment from the bottom up, very much like an equity portfolio. Whereas actually, if you, in a fund of funds structure or a primary fund, you obviously give your money to a private equity manager. They will then go out and buy those companies. and your capital is called over time. Whereas we have direct control of which specific companies we invest alongside. And that is as a result of our deal flow, which I'll talk around a little bit more in terms of NB's private markets platform. And what's the outcome? The outcome is, you get access to a diversified portfolio across sector, across underlying portfolio, a private equity manager, and across company size. And again, I'll talk about this in a little bit more detail when we come to talk about the portfolio as a whole. And ultimately, you get a diversified exposure to high quality private equity managers in their core area of expertise, so in their specific area or niche, which I think is really attractive. So just spending a little bit more time, just for those of you who don't know who we are at Neuberger Berman and NB, we are an independent, employee-owned asset manager, global asset manager, running about $500 billion at the moment. We have offices in 24 different countries. And in terms of the AUM split, it's equally split across equities, fixed income, and alternatives. The balance of the alternatives exposure actually is within our private markets platform, as you can see on the left-hand side. So we're running around 125 billion in private markets across a variety of strategies. And ultimately, what this means is it says we're an industry leader with an integrated platform and attractive market position. I think the key thing to highlight is we are not a direct investor like an OCI. What we're looking to do is we're looking to partner with leading private equity managers and help support them in making their investments into their underlying companies, whether that's supporting them and financing or giving them money for their primary strategies, to help support them in co-investment, which obviously is what's NBPE's focus, secondaries, private debt, cap solutions, and other equity and credit strategies. And we are seen, the way we explain it, as a capital solutions provider. So across the capital structures of a lot of the underlying businesses, we look to help support private equity managers. And as a result of this, and as a result of us, having relationships over the last 35 years, we get great deal flow across access to these managers, which we'll talk around in a little more detail. Just on the next slide, you can see our private markets team. It's very large and very stable in terms of senior investors. But again, this all stems, 420 global private markets professionals, 190 on the investment team across 15 different offices globally where they're based. Average age of 21 years of senior investment experience and 98% stability. And so what? So what does this all mean? What this means is actually, and particularly focusing on co-investment, is we have a very large and robust deal sourcing engine, particularly for our co-investment platform. And we're reviewing 11 deals a week at the moment in co-investment across multiple sectors and across different private equity managers. So if you take, again, a direct manager, for example, they typically on an annual basis will do anywhere from maybe 6 to 10 direct deals, i.e. they're buying the business, looking to develop the business, and then ultimately exit in a 3 to 5 year time period, as Stephen said, for OCI. Whereas, for example, last year, MB across our platform, we invested about $4.5 billion across 60 different private equity co-investments. And that deal flow enables us to be really targeted in our approach and have a very much a bottom, build portfolios investment by investment from the bottom up, providing diversified exposure for investors. And just to give you a little bit more context, so we reject typically about 90% of all the deals we see across our platform that we get shown. So just diving a little bit deeper into NBPE and what we look to achieve. So on the next slide, you can see, the portfolio as a whole today. As you can see on the right-hand side, some key portfolio stats. So 1.3 billion in size, 98% of fair value invested in direct private equity, 82 investments across 52 different managers. Talk about that diversification across both manager, but also unlike a fund of funds position, you're getting meaningful exposure. We're not talking around 500-600 different underlying companies. It's pretty diversified, pretty concentrated. So Action, as you can see on the left-hand side, is our largest holding at 5.2%. And I'll come and talk about Action in a little bit more detail. And you can see 77% of the portfolio fair values in the top 30 investments. The number on this page, actually, I will spend 2 minutes or a minute just talking about, is the average holding period. And I know that a number of my Peers have spoken about the average holding period of private equity investments over the last number of years have increased. And I think we're as you can see from the portfolio, that is the case. Typically, the average holding period for a lot of our investments is anywhere from 4 to 7 years. And the portfolio is relatively mature. There's an interesting article actually in the Times last year, which said that NBPE was pregnant with realizations. And although I didn't particularly like the title, it kind of explained quite nicely that we are in a good place in terms of we've got a number of it's a high quality portfolio, but with a number of businesses that are as and when exits and realizations continue to happen, we're in a good place to see a good uplift to some of those. And then, as you remember on the first slide, I showed you the number. It's about 36% in terms of average uplift on realizations and exits over the last 5 years. So I think this slide is key for me. It looks at some of the benefits of the co-investment model, the ability for us to build a portfolio from the bottom up. As you can see, there's a clear focus on diversification across sector, enterprise value, which is the same as company size, and clearly vintage year. And I think from my perspective, I'll give you an example. So recently we had an exit last year in Activity, which was a data analytics, healthcare data analytics company, which was bought by KKR. We were a co-investor in that company that ultimately was sold. We then got proceeds that were realised back to us, and we made 2 subsequent investments in the healthcare space, which I'll talk around in a little more detail, Benecon and Zeus. So actually, because of that, we were able to identify our weighting in healthcare dropped, and because of the deal flow across the MB platform, we were able to allocate to new healthcare deals as they came across. I also think it's important just to flag in terms of company size. NBPE focuses on the mid-market and mid-market buyout. And what this ultimately means is we're looking for established, profitable businesses that are growing their revenue and EBITDA over the long term, with strong management teams backed by best-in-class private equity managers with a clear value creation strategy. We're not investing in any early stage or venture portfolios. These businesses are already profitable and have a clear plan in place. And I think it's important to understand that as important to us is the underlying business as well as the private equity manager that's bringing it to us. And part of our due diligence is we look at the business first and the underlying company and the sector it's in, and look at that on its merits. And then we look at the private equity manager as well, who's bringing this business to us. And I think that's a really important part of the process. It's not just someone brings us a business and it's one of the leading PE managers and we say yes to every deal. We go through the same due diligence process for every single deal we do, looking at the business, look at its fundamentals, do our own analysis and work, and then we'll look to invest, to move the process forward. I've mentioned the vintage year diversification, as you can see, 5.2 years in terms of the average. So, but also I just think it's worth spending a couple of minutes on the geographical exposure. And clearly we focus on the small and mid-cap space. And I know that both Stephen and Andrew mentioned and talked a lot about how companies are staying private for longer. The availability of capital means that fewer companies are coming to market. And so actually, if you look at our portfolio, we're very much focused on domestically focused businesses. And it allows you to get access to some of these private companies that you wouldn't be able to get access in the public markets. And someone recently said to me, or the other week, they said, look, the reason I'm holding NBP is I get exposure to the small and mid-cap market in the United States, for example, with the allocation of 80% focused on the US, given it's the largest and deepest private equity market, and exposed to those companies that I can't get access to in the public markets. And we all know, and we've spoken about it a lot this morning, how public markets have been dominated by a small subset of stocks, and the general consensus, we think this will broaden out over time. And actually, domestically focused businesses have been, over the longer term, the driving force and where people have generated a lot of growth. And we still think that still is the case. And if you look at our last 12 months revenue and EBITDA growth of underlying portfolio companies, they're still growing in high kind of teens, both from a revenue and EBITDA perspective. So I just thought it'd be worth kind of highlighting that point around the geographical exposure and the access that this portfolio gives to investors. So just looking at it in a little more detail, the top 10, I won't go through companies these in huge detail, but just to give you a bit of a flavour, because I appreciate what Stephen was talking around and saying that, private equity is opaque, and it's difficult to relate to a lot of these businesses to actually businesses that you know yourselves or you see on a daily basis, particularly some of these more domestically focused businesses in the US and across Europe. But just to give you a bit of a flavour, as many of you know, Action. So Action is owned by 3i. It's been I think the Times described it last year as one of the most lucrative private equity deals ever. And it's a phenomenal business. Obviously, it's a non-food discount retailer, primarily across Europe, around 3,000 stores. They looking to add 300 stores a year, a strong like-for-like sales growth. And it currently is about 5.2% of our portfolio. You probably look down the sponsor or GP column in the middle, and you'll see some sponsors of private equity managers you'll know very well, maybe like the names of Platinum or Cinven or 3i, but others you won't know. They're sector specialists such as Shamrock Capital or AEA or Revenance Capital. And to give you another bit of a flavour, financial services is a key an area that we like. And we like buy and build or multiple M&A transactions, and we back. Revenance Capital is a great example of this. They're a firm that has done this numerous times, and Osaic is a independent wealth management firm in the US, and their value creation plan is to do multiple M&A transactions to go and buy independent wealth management businesses and IFA businesses and put them under the Osaic brand. It's doing very well. Solenis is a specialty chemicals provider, so it does, for example, things like water purification, both for industrials and for consumers, so pools, and again is a great performer. The other one I'll mention actually is Branded Cities. Interestingly, Shamrock Capital, many of you might not know Shamrock. Shamrock actually was the Disney family office for a long time. The current management team spun it out, I think in 2017. And Branded Cities is a great business. It's in the North American advertising company. And it's one of our best performers over the last few years. And Branded Cities, they own a lot of the billboards in Times Square and in Las Vegas. So with the, for example, in Las Vegas with the Grand Prix and the Super Bowl last year, had a really, really strong performance and continues to perform well. A couple of the new investments for the portfolio of the last number of years, or last year particularly. And as you can see, an eclectic mix. So 2 Healthcare, Benecom, which develops and administers self-funded employee health benefit programs, so in the healthcare insurance space, and Zeus, which is a pioneer and developer it makes polymers or for non-invasive surgery, so tubings for non-invasive surgeries. You've got FDH Aero with Audax Partners, which does global supply chain and hardware, electrical and chemicals for aerospace and defense companies. And Mariner, as I said, financial services, another interesting business, which is a leader in the RIA, so the investment advice services in the United States. And I think it's really important to highlight, you can see actually on the second, third line down, actually, NBPE's fair value investment into these companies. But I think key thing to focus on, and I hope I made it clear when I was talking about the platform, is that NBPE is not taking its own investment into these businesses. We're doing it as part of Neuberger Berman. So we're getting the best of the sourcing and deal flow from NB, but then taking a stake for the strategy. So I'll take Mariner, for example. So Mariner, NB as a platform, invested $700 million into Mariner, and NB had a $30 million stake or position in that $700 million. And deals are allocated on a pro-rated basis from the platform. And typically we look to invest 2 to 3% of our NAV into new investments. So again, talking around that diversification, we want, if the company performs incredibly well, we want it to be material enough to increase the NAV and to be passed down to shareholders. But also from a risk perspective, we don't want one position to be outsized in any particular way. In terms of the next slide, just talks about some of the new investment summaries in terms of high quality GPs with strong market positions, with high barriers to entry, and looking for long-term secular growth. And I didn't mention before, but actually 2 key themes we look at when we're looking to invest in businesses is long-term secular growth, it says, and businesses with low expected cyclicality. So more defensive in terms of their end markets, and high barriers to entry is a key proponent of that. I'll spend a couple of minutes just talking around realizations, because I think it's a really important and really interesting time at the moment. Clearly, as you can see, there's a high quality portfolio with multiple liquidity routes is the title of this slide. An NBPE of the last year had $179 million of realizations received. I won't go into detail, but you can see on the right hand side, this is across multiple different avenues. And I think it's really important to kind of highlight that one thing we do in our underwriting, but also I think Stephen also mentioned as well, is sentiment towards private equity. Clearly, it's been a different, more challenging environment for private equity managers more recently. We've talked around that, and a lot of people have highlighted it this morning as a result of kind of increased interest rates, financing being more expensive, the disconnect between buyers and sellers. And clearly, that is improving over time and is improving as we move into this year alone. And there are a lot of companies that are looking to potentially look to exit, or private equity managers looking to exit positions in the next couple of years. But I think also it's important to highlight that ultimately, in private equity, the simplest form is private equity manager buying a business, looking to add value and to ultimately sell that over time. And the sale is incredibly important to us. It's something we look at in terms of, and that may sound very simplistic, but actually, I think it's important to highlight that actually a lot of the realizations we've had over the last number of years, clearly the IPO market's been shut, but we've still been able to turn over about 17% of our portfolio. And that's as a result of selling to strategic buyers, to other companies, but also selling to private equity managers. And that's one of the benefits of focusing on the mid-cap companies, and the fact that you can all sell to large private equity managers who are, large cap private equity managers who are looking to take the business on to the next stage. So I thought that's a very interesting point to highlight and make. And I think, clearly it's been, as I said, more challenging environment for realizations across the private equity market, but we're still very confident of the portfolio we have. And actually, we think that, hopefully we can continue to have some more positive realizations in the year ahead. I think the last slide before I talk about the conclusion, just to talk briefly, I know Stephen mentioned this again, just capital allocation now is very important for us. And in terms of it, as I highlighted, we at NBPE has a long-standing dividend policy. We've returned about 420 million to shareholders since the introduction of the dividend, and through dividend and buybacks, and 360 million pounds of that is since the dividend was introduced in 2013. And at current share price, the current yield on the dividend is about 5% at the current share price. And I think from a capital allocation perspective, the board review it effectively have a three-pillared approach. It's balancing new investments, balancing the dividend, and balancing buybacks. As you will, it's something that obviously we track on a regular basis, and we look to obviously will continue to do so moving forward. I'm conscious of time. I just thought I'd spend a couple of minutes just very quickly talking. Clearly, the last couple of years have been slower in terms of exits, but we ultimately remain very confident in the portfolio and the positioning we have. We think NBPE is a very differentiated model to peers. We have obviously our focus on co-investment, backing, investing directly in private equity companies alongside leading private equity managers. We're able to control the investment decision and our pacing, and it's very fee efficient. We've got a highly experienced team, leveraging the strength of Neuberger Berman's $125 billion private markets platform. We have a robust long-term performance of the strategy. As I said, revenue and EBITDA, strong revenue and EBITDA growth, and 5-year trailing uplift on exits, and 2.3 times gross multiple on realised investments. I think we're very well positioned today. We are lowly levered, 1.2% in terms of our only 2% geared, got great available liquidity, and we had a strong year in terms of realizations next year, with the portfolio being at 5.2% in terms of the vintage year diversification. And so finally, just kind of NBPE's value proposition. What you get is access to a direct portfolio of private equity investments alongside world-leading private equity managers. We're leveraging Neuberger Berman's platform, as I said, in terms of sourcing and execution. We think the co-investment model it allows us great flexibility in terms of capital deployment, but also being able to start and stop investing and respond to markets dynamically. Investing globally, but with a focus on the US, and particularly domestically focused businesses. And finally, talk about the co-investment model being very fee efficient and capital efficient. And with that, very happy to open to any questions, Jeremy?
Yeah, Luke Mason, thank you very much indeed. Fascinating. Pregnant with realizations. I love that quote. That's brilliant. In fact, that's picked up as well by one of our questions. How do trade realizations differ from an IPO?
So trade realizations, so effectively you're selling to a trade buyer. So ultimately this company will still remain private, but it'll be sold to a trade buyer. Whereas an IPO, obviously you're coming to the public markets. So in that regard, that's just a very simple explanation.
Yeah, there are actually quite a few questions come through. Not got much time left. Very quickly, I was interested in your chart showing the allocations of where you are geographically. And this is picked up by one of our questions. What are the major attractions of the US over Europe? The US is what, 79%, Europe 20%, rest of the world and Asia 1%.
Yes,
Give us more depth on why and what are the attractions.
Yes, I suppose. Well, the US is the largest and deepest private equity market. Historically, we are a US centered organization. So we were, our head office is New York. We've got investment centers in Dallas and also on the West Coast, but also Europe as well. So we're not saying that we don't like businesses or deals across Europe and Asia. And actually across our platform, we've actually seen a lot more deal flow from European and Asia businesses more recently. But actually, as I said, the portfolio is quite mature in terms of its approach, and we like US domestically focused businesses. So actually, we think that clearly an awful lot going on. And I think Andrew mentioned it over the last number of years. There's a lot of kind of not political risk, but there's been a lot of noise politically. But we still think the US economy is doing very well, and clearly there's a little bit of uncertainty in terms of the new administration, but we do think that actually it's very much going to be pro-business, and so we're very confident or comfortable with our allocation to the US at the moment.
And the question I've asked all of the presenters this morning is, what do you think the catalyst will be to start to narrow that discount?
It's a good question, I think, and I probably it's not anything new that you'll probably hear from me in terms of. I think from our perspective, it's going to be, as many of others have highlighted, it's going to be continued long-term performance. It's going to be sentiment and educating the market in terms of the benefits of the listed private equity companies. And it's going to be investor confidence, I really think. But I really like Stephen's approach, or what he was talking about in terms of saying, look, the discount is an opportunity. If you think actually the long-term average of these discounts, the longer term, fund of funds trade anywhere, as Richard was saying, between 15 and 25% discount, and the direct investment companies, private investment companies trade anywhere between par and say a 15% discount over the longer term. So you think at these wide levels, as sentiment and the market improves and people have more of a risk-on appetite, we should hopefully see NAV and share price continue to increase, and hopefully the share price narrows and these discounts close. So, and ultimately, as highlighted by a number of our, number of my guests, the other guest speakers, NAV performance drives ultimately shareholder return.
Yeah. One final question: do you have the option to set your allocation to any company, or is this dictated to by NB?
Yes, yeah, we have. The way it works is that the deals are approved at the platform level, and then we at NBPE, the investment committee at NBPE, we decide whether that deal will go into the NBP portfolio, and more from a portfolio construction perspective, looking at the deal, what we've already got available to us in the portfolio, etc. So, yeah, it's not that every deal that gets allocated through the NB platform goes into NBPE. As you say, we did 62 deals last year. And of those, actually, NBPE only invested in 4 of them. So it's very much we're able to dictate, and we look at the portfolio from both the bottom up and the top down, and are able to allocate and use the deal flow that comes through the NB platform.